The asset management companies have, of course, rendered a very good account of themselves, the fund managers in particular, in 2017, by generating extraordinary alpha. In fact, that's been the record of Indian fund managers for the past, 15, 17 years. Has that history been rewritten in the last 3 or 5 months when alpha generation has failed? Is this an aberration? Can we continue to see fund managers generate alpha? Or are we going to follow more developed markets where after a point, alpha generation became difficult and size as well as regulatory conditions made all funds more or less commoditized and surrendered their uniqueness to exchange-traded funds, ETFs. Will we also go that way? Is that round the corner? That's the question we are asking, and we have a panel of perhaps the best fund managers and one AMC CEO with us. They're all well-known people: Manish Gunwani of Reliance, Navneet Munot of SBI, Vitri Subramaniam of UTI, Harish Krishnan of Kotak, and Lakshmikant Reddy of Franklin Templeton, the one CEO on our panel, Ashish Somaya of Motilal Oswal. Well, let me start straight away by asking that question. Manish, do you think the age of alpha is over?
No, I don't think so. To go a bit more granular, I think of it in 3 phases. So the first phase, I think, is where competition picks up, because obviously, historically, the alpha creation in India has been very high. Part of it is due to information asymmetry, asymmetric access to managements, which used to happen, let's say, a decade back. Now, clearly, that part is going out of the game because the markets are becoming more and more efficient. The markets are becoming more and more institutional. So to that extent, I think there will be a first phase where alpha generation will become a bit more challenging next few years. And maybe then there'll be a phase where ETFs do well. But I do think that the end game being ETFs, I view it as a very doubtful probability, because if you think about ETF is just one quant strategy, because what is an index? Typically, most of the stock market indices are momentum strategies. It's a momentum algorithm, right? Because the higher the market cap of a company, the bigger weight you're giving to that in the index. So just like all quant strategies contain the seeds of their failure within their success, if more and more people follow that, any momentum strategy will finally reach a point where it doesn't work.
So your point is mutual funds will continue to prevail over exchange-traded funds. You don't see them surrendering their uniqueness or their alpha very quickly.
Long term, yes, but I also feel that the alpha expectations have to be muted. I don't think 8-10% alpha funds are possible, to be honest.
Okay.
I think 2 to 4-5% alpha for a large cap fund will be a good alpha to
Yes, the difference in fund management fees is, I think, 2.5% and 0.5%.
So, most expense.
So let us see whether investors will bite. But your take, Vitri. Same question. Can Indian fund managers extend this alpha generation phase a little more? I mean, the question of the topic itself is this alpha generation sustainable?
I think if you look at the trend, even in India, and the data is already indicating it, there is a challenge in terms of alpha. I think Manish also alluded to that the extent of alpha is coming down. And I think it's important to understand this because, see, markets by definition are not zero-sum. There is money that is created when markets go up. But alpha, by definition, is a zero-sum game, right? Because if I have to earn alpha, I'll have to take it away from one of the other remarkably smart gentlemen seated at this panel and many others who are not in this panel. So that is the nature. And therefore, I think as the level of skill and as the level of competition keeps increasing, it is a natural corollary that the alpha will continue to exist. But I think, and switching hats over here, from an investor's point of view, how does he know who will actually generate that alpha? And I think that is the crucial issue which then starts to sort of dominate the mindset of the investor. Irrespective of the fact that we as managers and as manufacturers may believe that we can create alpha, the reality is that the data shows that as the level of skill increases, alpha comes down. And anybody who's interested in this, I would strongly urge you, read Michael Mabuson's Paradox of Skill, wonderful article written 7 years ago. And I think, the takeaway from that, he actually talks about sports, he talks about investing, and everywhere the conclusion is the same. When the skill level goes up, it actually becomes a very, very tough game and virtually impossible to pick beforehand.
But now, once the skill level goes up, it is difficult to sustain. But have we reached that level, Harish?
So clearly, in our opinion, we still seem to be some time away wherein we can completely erode, or the industry can erode itself from generating alpha. I think part of historical analysis is to also remember that this is not the first time wherein we've had negative alpha, say on a one-year basis across most categories. We've seen negative alpha, say in the large cap categories, multiple times, be it in 2002, 7, 13, and 18 now, right? So alpha is by nature a cyclical phenomenon also. I think there is a greater amount of focus that is being given on, say, a 1 year or a short-term time frame of 6 months, etc. And the real idea is that we need to elongate the cycle for comparison and to bring in a concept which is very familiar to all of us, which is rolling returns. So just taking on from Vetri's point of Michael Mabuson's wonderful article, wherein he talks about sports. For example, in the case of the marathon, the winner of the Olympic marathon from over the last 80 odd years, the time to complete the marathon has reduced by almost 25 minutes, right? But the gap between the number 1 and the number 20th, that used to be about 38 minutes. That has shrunk to 7.5 minutes. So yes, we are all getting more and more skillful, but the relative gap is reducing. The second point I want to bring around is that we seem to also talk into the sense that just because what has happened in, say, US, wherein ETFs have taken off in a very big way, something similar will also follow into what happens into, say, a market like India. And clearly, if you look at it, ETFs as a product have been around very, very long in US, but they really took off only in 2007. Wherein the cumulative assets under management were about 500 billion of ETFs, and now they've grown more than 10x. Now, if you look at the market structure in US and the market structure in India, the institutional investor base, which are very homogenized, used to account for as much as 60% of daily traded volumes in US. Out here, if you look at on a normal day between DII and FII, it would not be more than, say, 30-35%. So we still have possibly a decade or so. But I would think that, as we go further and further into time, this will kind of diminish, maybe at a slightly more gradual pace.
A decade is a very long time. I mean, if you can maintain alpha generation for another decade, that reassures your bonuses for a goodish bit. You agree, Navneet? You think the industry as it is placed now, the amount of knowledge, the amount of research and skill that's already invested is still not good enough, and you can continue to generate alpha for another decade?
So globally, as Vetri mentioned earlier, the two large forces, democratization of information and institutionalization of markets, have reduced the alpha. And of course, as Michael Mabuson says, that an average fund manager is smarter than before, and the benchmark is smarter than before, which is making it difficult. But looking from the Indian context, of course, one can see the last maybe few quarters, a year or two, and say that whether the alpha generation is over, are we not be able to generate the alpha going forward? I still think there are a lot of arbitrage. So you have to start with a fundamental belief that markets are efficient, there is wisdom in crowd, but at the same time, the wisdom of crowd at times becomes many of the mob, or there are a lot of other opportunities, there are a lot of other arbitrages which are available as long as you exploit them in a systematic manner. So one like simple arbitrage is a time arbitrage, where there are a large number of investors who are focusing on what the US Fed will do tomorrow, what was the result of a state election, what will happen in the next quarterly results. And if you have a horizon of 3-year, 5-year, 10-year, you can ignore a lot of that noise, and that gives an opportunity to generate alpha. And the second big for a market like India, where you have large number of stocks, is a research arbitrage. So, I mean, if you have an ability to get information more than the market, not from the company, but let's say a channel partner, customers, vendors, different kinds of people, you get more macro data, macro information, you get an analytical edge. I mean, you analyze that information differently than the market, and the behavioral edge, which over a period of time with the experience a fund manager or analyst deploy. I think with all of those, I think you can create a research arbitrage, and you can create, and you have the time arbitrage. If you employ that systematically, I think still there is a lot of opportunity for generate alpha. We believe in ETF. We are the largest player in ETF. I think there will be a market which will look at the passive products who would just like to get that beta. But I'm sure there would be fund managers who will consistent, I mean, not a consistent meaning every quarter or every year, but who can exploit some of these inefficiencies and can deliver alpha. And I think there's enough market in India for both of those players.
Okay. Well, I'll take you up on this, that you can create special skill on outguessing the same events differently because you're more skillful, whether it is the US Fed interest rate cycle or whether it is the election cycle in India. But do you still have alpha creation because you know which is the corporate governance that is going to fail, which is the auditor who is going to resign? Are there still pockets, Lakshmikant, that is not totally democratized in India?
Yeah, sure. There will be, of course, as the market is getting more and more efficient in terms of both the disclosure by the corporates, there are also disclosures in terms of, there is a business responsibility statement that companies attach with their annual reports in terms of how they're complying with various, rules and regulations. Right? So there will be stray cases. I mean, even in very efficient markets like the US, you will have an occasional WorldCom, you'll have an occasional Enron. There will be certain cases, but I would like to believe that we are getting to that point where pure accounting diligence, some of these things are not source of sustainable alpha for long-only investors. By and large, I think the quality of the information, the quality of the, the governance practices, etc., have improved to the point where and more importantly, a large part of the institutional money also has become over a period in time more and more quality conscious as to what kind of companies they back, etc. So I would believe that that in itself alone is not going to be a source of alpha.
Okay. Let me take up on what Navneet said, that even when there is democratization of information and institutionalization of fund management, the skill of the fund manager will continue to be important or will be alpha generating. But as the only CEO on the panel, can this be, sustainable? What if the fund manager moves? Can the mutual fund company generate enough processes to ensure that this outsmarting the others continues?
So, if you allow me to step back for a moment I have something to say on the discussion and then I'll come to this. I think one is I'll just put in context why there is so much discussion about alpha which is happening only right now. And
because for the last 6 months you all didn't generate.
Yeah, so thanks for answering that. You need to keep the context in mind. Nobody's talking about it, but if you see 2017 was a year where the Nifty was up 28.5%, CNX Midcap 100 was up 48.5%, and BSE Small Cap was up 57%. Yeah. And then in 2018, so that's one way up. Now, very ordinary pedestrian example, but if I tell you that you're traveling in a Shatabdi from Mumbai to Ahmedabad and the whole train is going at a speed of 140 kilometers per hour and you are sitting inside the train, all of them are sitting inside the train, but they have to reach Ahmedabad faster than the train. I don't know how easy that is, because if I have to beat an index, 100 stock index goes up 57% in a single year and I beat that. Should I be doing that, and what risks will I take? Number one. Number two is, you see, when 2018 came, The Nifty kept its journey up. You know, from the bottom of Demon till August 2018, the whole index is up 55 to 56%. I don't think 2009, when UPA 2 came to power, there was a brief span where everybody underperformed because the index doubled in 6 months. So I think we need to keep the operating context in mind. Small and mid cap has had just a one-way down 35% decline this year. So I think...
Are you making a case that you should not generate alpha?
No, I'm saying that there will be circumstances and situations and landscapes. Look, we are stock pickers. If the whole 100 stock index goes up 49%, I think for some time stock picking won't work. The index will outsmart most of the guys. So there are situations where they may not beat the index. I don't think that window should be used to draw conclusions. That's the limited point I'm saying. We should give it some time. If you see from September till now, I can assure you everybody's beating the index. Maybe you can correct me if I'm wrong. Everybody's beating the index from September till now. So I think this will change. Sorry for digressing, but coming to your point on skill, I think that if you are in active management, losing the fund manager is a real risk. Investors should be aware of it. That you are betting on active management, fund managers making the right or wrong decisions, plus the fact that fund managers may not be there forever with a particular firm or managing a particular fund is a real risk. But coming to your point, of course, it is our job as a manager, promoter, owner to ensure that the best talent is ring-fenced in whatever way that we can. I think processes play a very, very important role, because if you see in equities, we are actually in a business of uncertain outcomes. We don't control the outcome. When you cannot control the outcome, the only thing you can control is the consistency and quality of your inputs. So that's where the process comes in for continuity, but the risk is real.